Let's stay on the markets and bring in Mark Matson. He's the founder and CEO of Matson Money. Mark, always good to see you. I've been following your career for some time, and I know you typically hold these large conferences. A lot of investors attend. You share your investing advice. What's your best advice right now to the average investor that is essentially watching a market melt up on pure hope?
Yeah, well, anytime there's a chaos, which there have been for quite some time now, investors tend to have their time horizon tends to shrink, and they become more myopic in looking at the short term. When things are chaotic and the market's still down for the year, you need to look longer term. You need to be looking 10, 15, 20 years, which is extremely difficult for investors to do, especially when you're looking at COVID coming back seemingly stronger than before, at least temporarily. And then you have the riots, you have a lot of chaos. So fear goes up, paranoia goes up. Yes, it's up today, which is awesome. But investors really need to stay focused on that next 10 to 20 years, not the next 10 to 20 minutes.
Hey, Mark, that sort of leads me to my next question. This uptick we've seen in day trading, it's one of the top searched things on Google right now. Do you think online trade platforms are helping to get middle America sort of in on this market? And is that a good thing?
Well, I think it's a terrible thing, actually. It's kind of like a drug dealer giving out free samples to people. Look, day trading is nothing but speculating and gambling with your money. And there was a recent story about a young millennial that killed himself from trading on Robinhood and mistakenly not knowing that he actually, wasn't negative $700,000 in the hole. Speculating and gambling is never a good thing for you to do with your money. And these things definitely entice you. Options, calls, commodities. All forms of speculating and gambling have nothing to do with creating your American dream and staying long-term focused. And you're seeing more and more and more. It's like online gambling platforms, bad for investors.
All right, Mark, you tempted me here. What is, you mentioned the next 20 years for the markets. Where does the market go over the next 20 years? We'll be obviously out of this current presidential cycle.
Yeah, so if you look historically, the S&P averages about 7% a year. If you look at small value stocks, those are stocks that have high book to market value and are in the bottom half of the market. They historically make another 3 to 4% rate of return on top of the 7. So if you start to look at long-term equities and then you diversify globally, you don't want to have it all just in the U.S. That's a big problem I see a lot of investors making right now. They're so myopically focused just on the U.S. stocks. They have to be international and emerging markets. And then to the extent that you're afraid of volatility in the short run, you offset that with high quality short-term fixed income. So when markets do crash, like at the beginning of the year, we were able to move $300 million out of fixed income into equities while they were distressed.
When you take a look at the big picture, Mark, what about what's happening in big tech right now? I mean, the NASDAQ, as we speak, at a record high, NASDAQ 100 hitting a record high. A lot of those big individual large cap tech stocks at record highs. Do you see a bubble already there? Is a bubble forming in big tech? Do we need to look out?
Well, it's reminiscent, isn't it, of the tech crash in the 2000s, and it was a massive crash. Anytime a sector gets low book to market value, has a lot of small earnings for price, you're looking at a situation where you're in growth stocks. Growth stocks historically have a smaller expected return than value stocks. So you don't want to double down on tech stocks. You don't want to double down on just sectors. And this recession and massive layoff of employees has definitely created winners and losers. One of the famous sayings that's been in the last 3 months is we're all in this together. Well, in theory, that's great, except this COVID lockdown has created massive winners and massive losers. And economically speaking, we're not all in this together. So you have to diversify, and you never know what new rules or regulations are coming out next. But don't double down on any sectors like tech stocks.
Mark, do you think the coming presidential election matters to the markets? Right now, the market can seem to absolutely care less, overlooking who could be the next president. Do you agree with the market?
Well, the markets got far greater wisdom than I do. As a matter of fact, all of the knowable and predictable information about the future is factored in today. Therefore, only random and unpredictable information will change market prices going forward. So I have no idea who's going to win the election and or what impact that will have. What I can say, though, is we've done extensive studies on if it's a Democrat or Republican president, if it's a Democrat or Republican House or Senate. And over time, over the last 70 years, I can't find any correlation between what party's in office or not. So investors would be better off instead of trying to play chicken with the election to just keep their investments long term and then not worry about what happens in the short term. I know it's the hardest thing to do. But sitting on your hands and staying long-term focused pays the highest dividends.
Mark, do you think the biggest catalyst for this market, at least in the short term, is whether or not we get another stimulus bill? And what happens if we don't get it? Because it looks like for the past few weeks, investors have really been betting on more government stimulus.
Yeah. Well, Dr. Art Laffer is on our advisory board, and we talk about this frequently. The stimulus bill does nothing to actually stimulate. It actually encourages people to actually stay at home and not go back to work. So I'm not a big fan of the stimulus bills. And then, of course, it creates massive deficits. We're looking at about $6 trillion of additional debt from the stimulus that's been done already. That's going to make it more difficult to borrow money in the future, could have higher inflation. You can't spend your way out of this recession any more than you can, or borrow your way out of this recession any better than you can any other recession. The only long-term hope is to get actual people back to work. Entrepreneurs have to take us out of this. People have to, there may never be, let's look at reality. There may never be a vaccine that actually works. So does that mean we're going to stay locked down for another 50 years? We have to start looking at entrepreneurism, innovation, technology. Those are the things that are going to take us out of this. I fear that another round of stimulus or borrowing isn't going to do much.
And if that's the case, Mark, are you selling into this rally? Because I can make the argument this rally we've seen over the past 3 to 4 weeks is predicated on stimulus coming from lawmakers, in many respects, who have gotten it wrong. That stimulus coming in 2 weeks.
Yeah, well, we're always rebalancing. So if you looked at the beginning of the year when the market crashed, our clients are about a 70-30 portfolio, 70% equities on average. So when the market crashed, we were way under that target, sold fixed income, bought $300 million worth of equities while it was down. And of course, it's ran way up since then. So when it gets about 4 to 5% over the target, we will be selling equities and buying more fixed income. And that turns you into a contrarian. You're always selling relatively the thing that's high, buying the thing that's relatively low. But you have to take all emotions out of that to do that.
All right, let's leave it there. Mark Matson, founder and CEO of Matson Money. Good to see you. We'll talk to you soon.
Great to be with you. Thank you.